Hello, everybody, and welcome to another episode of the Scaling Alpha podcast. Today, I'm joined by Vijay Manghnani, Managing Partner, Chief Underwriting Officer, and Chief Investment Officer of King Ridge Capital. Vijay is a distinguished leader in the insurance-linked securities, ILS for short, sector, previously helping build the ILS team at PIMCO and holding senior roles at AIG and Newport Re. With a PhD in meteorology and a deep expertise in catastrophe risk management, Vijay is now at the forefront of redefining how capital markets engage with insurance risk through King Ridge's specialized multi-strategy platform. Vijay, thanks so much for joining us today. I'm really excited about this episode and talking with you today.
Thank you, Ben. Same here.
Happy to have you. Tell the viewers a little about yourself and your journey to the financial industry.
Absolutely. So, as you mentioned, I have a PhD in meteorology. I have a science and engineering background, but I took a interesting detour into the financial industry. As I was finishing my PhD in meteorology, in North Carolina State, I really wanted to work on real world applications of the science. I felt that that's where my calling was. I wanted to really take the science that I had learned at the university and see if I could make an impact on real world decisions. So I started looking around, and around the same time there was this emerging industry or an asset class, you can call it, which was developing, which was called weather derivatives, which is like an intersection of weather risk and financial derivatives. That sounded fascinating to me. It seemed like the best combination of the science of weather and climate that I was passionate about and taking it to the finance world.
Explain to our viewers what a derivative is, just in case.
Absolutely. So a derivative is an instrument which it's like an option or a call option the reason it's called a derivative is because the underlying index could be a stock or a bond, or in this case a weather parameter like temperature. You're not trading those underlying stocks or bonds or the weather parameter. You're trading a contract that is derived from that. So a call option, you would be trading a certain attachment point or a trigger point of the option above a certain threshold. So it's based on the index, but it is a derived version of the index. In the financial markets, these are very standard instruments, and all it's very commonly used.
So tell me about these weather derivatives and what was the need in the market that caused them to spring up and get some traction?
So what was happening around that time was, there was a lot of need. We were just coming out, of some series of warm years, not unlike what we have experienced in the last few months, actually, and what we are expecting to experience given the El Nino that's upon us. There was a series of warm years, and that impacted energy utilities quite a bit. The winters were warmer than expected, and the summers were much more volatile. And when winters are warm, there's not much business for an energy gas provider. There's not that much gas being demanded. And that they realized that their bottom lines were getting impacted by weather volatility. And the simplest way for them to hedge that risk was to purchase a weather derivative, a product that would protect them in the case of warm winters, or on the flip side, a cool summer, because then the power demand would go down.
And
So
so they're selling their risk that requires a buyer to buy their risk. Who are the people buying
exactly.
their risk? What were the types of parties that were buying that risk?
The parties that were buying the risk were energy trading companies.
Okay.
And these firms, they were let's call it speculators. In this case, sophisticated speculators, because they would hire people like me um, to determine whether they could take that risk on from a utility. Um, and some other large insurance and reinsurance companies who are in the business of taking risk away from other corporates and individuals. So that's their core business, to take risk from society and distribute it to capital markets. So
Got it.
those were the players who were on the other side of the utilities. And utilities is just one example. You can think of agricultural farmers, who might get impacted by drought or floods. Um, so there was a whole ecosystem of risks that, started appreciating the value of trading away the weather risk that was embedded in their business.
So that was developing at the time, and that was so I interrupted your background. So at the time, the weather derivatives were getting some traction, and then where were you, and then what subsequently developed in your career after that point?
So, I wrapped up my PhD and packed up my bags, in the car that I had, packed up all my stuff and drove all the way to Kansas City.
Oh,
And, I got the job of a climatologist at this energy trading firm. That's probably the first climatologist they ever hired. And I was the only one there. We had a few, meteorologists in the broader team, but I was the only one responsible for climate risk. Um, so I show up there, I was on this energy trading floor, and my first task was to build a seasonal climate outlook for the commodity traders on the floor.
mm.
Um, so talk about wanting to be, close to real world applications, and then being, careful what you wish for,
Yeah, yeah,
because this
yeah.
was this was real world application on steroids. Because I had these, very experienced commodity traders who have bet and made and lost tens of millions of dollars trading, various parts of the U.S. Market. And they are now looking at me to tell them what the coming summer and winter will bring. And I am straight out of grad school, never been exposed to anything in the finance world. So it was a steep learning curve,
Mhm.
and the
We
pressure
all go
cooker.
through we all go through those at one time or another, don't we?
Absolutely, absolutely. It was definitely a pressure cooker environment. Um, But at the same time, it was thrilling. It was very, gratifying as well as, exciting to be able to deliver and see the output being actually put to use. Um, and that's what got me hooked. What started out as an experiment, to see if there is real world applications and whether I could make an impact. The first taste of it was enough for me to, stick with it for the rest of my career.
Where did you go from? What's the biggest thing you learned there, and where did you go from there?
So, I did that for a couple of years. The biggest thing for me was, it opened me up to the whole world of finance, because I was on the trading floor doing these forecasts. I was also trading weather derivatives on the side. My kind of niche was sub-seasonal forecast. So I'm not a short-term um, meteorologist, right? I'm not going to be able, I'm not going to make a forecast for the next week. Um,
Hmm.
I don't even have the looks for it, so I just never tried. Um,
Yep.
but my niche was to make forecasts, from 2 weeks onwards to a month or 2 months. And
Hmm.
there was an opportunity, there. So I did that, while I was there, got a taste for trading
Hmm.
through that. And that's what got me hooked. Unfortunately, that company got enveloped in the collateral damage that happened after Enron collapsed. A
Hmm.
lot of the energy trading firms stopped trading after that.
Hmm.
So I ended up, in a reinsurance firm
Hmm.
after that, and they were also doing weather derivatives. So I joined them to help them with that. But being a reinsurance firm, uh, catastrophe risk was a much bigger risk on their portfolios than weather.
Hmm.
So that's what got me into catastrophe risk management,
Hmm.
and extreme risk like hurricanes and floods and things like that.
God, so it's those are part of weather, but those are catastrophic weather versus
Absolutely.
normal weather. Is it going to be extremely cold, extremely hot
Yeah,
type of thing, right?
that's
That
right.
that,
That's
that
right.
makes a lot of sense. How long did you stay there, and where'd you go next?
So that was, I stayed at the reinsurance company, and then I joined Chubb, which is a large insurance company. They
Hmm.
are a global firm. And I joined Chubb to start a weather derivatives desk there, and also manage their catastrophe risk.
Hmm.
So I did that for about 8 years, I think. Very exciting times, building parametric, products for risk transfer for individuals as well as businesses. We would develop hurricane derivatives or hurricane parametric products along the coastline and offer it to hotels and small
Explain what you mean
businesses.
by paramedic products to the viewers.
Parametric. So these are products that these are risk transfer products that trigger based on a parameter that is defined by an independent agency. So
Got
think
it.
of the National Hurricane Center saying, "Hey, this hurricane went through this path, and it had a Category 4 intensity,"
Hmm.
and we would design products which would say to a hotel on the coast of Miami that, hey, if there was a hurricane of Category 4 or 5 within 50 miles of your location, there could be you will most certainly have some damages.
Hmm.
And we can design a product for you that is tailored to your risk profile, but triggers on the parameter that we choose for you. So we had a
Yep.
series of products along those lines, which
Suffice it to
was
say, say that this is really kind of now kind of closing the loop on how do you design a structured product,
that's
right?
right.
That
Yeah,
that locks in some sort of return stream, right?
yeah.
And so yeah, I'm seeing the story develop, and it sounds like you're just getting more and more experience, building up your repertoire of skills and analytical abilities on the core kind of risks and asset classes that this is developing into the firm you have today. Am I correct?
Absolutely. Foundational, without that experience, right? Without actually having, that on the ground experience of building foundational products, wouldn't have, gotten to where I have today.
Yep.
So definitely, that's a path that I couldn't have imagined I would take, but, that's
Hmm.
what got me here where I am today.
Yeah, no, that makes sense. And from there, it sounds like you went to PIMCO and AIG, right?
That's right. That's right. So, fast forward, I did my stint at Chubb, very, very fascinating company, where I learned a lot. Then I joined AIG when they were in a way reinventing themselves after the 2008 crisis. So I joined
Hmm.
them in 2012. They were really focused on bringing analytics back into their firm in a more serious way.
Hmm.
And they wanted to, really, I joined them to help, turn around catastrophe risk management of their global operations.
Mm-hmm.
So really built for AIG, from the ground up, their whole catastrophe modeling operation, from like when I joined, it was hardly anything. And, we ended up with like few hundred, analytic staff across the globe,
Wow.
supporting their, multi-billion-dollar business. Um, so AIG was fascinating. It's obviously, a very historic institution in
Mm-hmm.
America, more than 100 years been around. They've been through obviously a few hiccups, but they're still standing, which is, pretty impressive. And there's a lot of institutional knowledge in AIG that I learned, about how underwriting works, how models, get connected to risk decisions, and where there might be gaps. And most importantly for me, the lessons from AIG were, about the social purpose of insurance risk
Mm-hmm.
transfer, right? So, we would get the opportunity to interact with clients, of AIG, before and after catastrophe strikes. And we would be able to see, how AIG actually, delivered on the promise that they made. And
That's
that's,
awesome.
that's important. So that's stuck with me, during my experience at AIG. And then, I reached a point where, I was ready for the next challenge. And PIMCO, happened to be that opportunity. I got together with a few of my ex-colleagues and industry, friends, and we were looking to start up something like Kingridge back then.
Mm-hmm.
And we were talking to a few different, investors slash partners, and we ended up having a conversation with PIMCO, and they said, "Hey, why don't you guys join us and help us start our insurance-linked securities platform?" So that's what got us into PIMCO. Again, a great franchise, very, very amazing platform. Their investment process, of course, they talk about it a lot, how they bring, top-down secular themes
Mm-hmm.
approach and, marry it to, bottoms up in, instrument selection.
Mm-hmm.
Very rigorous in their risk and compliance. And, having worked in in large institutions like Chubb and AIG, of course, risk is important and how compliance is important, but working in an asset manager is a different animal.
Yeah. Yeah.
It's definitely a very serious undertaking. So learned a lot at PIMCO, and really our goal when we started Kingridge was to bring that institutional knowledge, institutional resiliency, focus on risk and compliance, and then marry that with the speed and agility of a startup, right?
It's
So we
it's
wanted,
very it's very interesting because you're sitting here starting these desks, these building these huge research teams, catastrophic weather research teams at institutions is like AIG, designing insurance products connected to weather and catastrophe at Chubb. Um, I'm gonna say it for you. There's probably only, I would assume, in the in the the people that have your level of experience that have transitioned to the asset management side of the table is probably few and far between. Would I be correct?
yeah, it's a very niche field to start with, right?
Mm-hmm.
Most firms who do this are either in London or in Bermuda, right?
Mm-hmm.
And it's a very small field, right? It's
Mm-hmm.
growing, but it's still a niche asset class, and the kinds of like it has attracted people like me. But yeah, we are definitely uh, you know there's probably you can fit all of us in one room.
Yeah, I'm
In
sure.
the
But
world.
then having you going into PIMCO, because anybody who is that's in the in the institutional investment management knows PIMCO's reputation. They're
Absolutely.
very well regarded when it comes to the sophistication, especially when it comes to structured products, and other non-liquid types of instruments of this nature.
Yeah.
Um, 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 how long were you there? How what were the kind of the key accomplishments that really and things you learned there that you built, and then to some extent transferred to what you're doing now?
Yeah. So, we joined PIMCO in 2019 and we were there till end of 2023. So about close to, 4 years. Um, and I would say, it was like starting, even if it is a large company like PIMCO, starting a completely new desk there, something that is not an asset class that they have dealt with in the past is
Yep,
almost like doing a startup, right?
got it.
Because there's no institutional knowledge about ILS in that firm, right?
Mm,
So we had to do a lot of education, think about all the investment committee meetings that we have to go through, educate folks about insurance, reinsurance, the opportunity in this space. Um, we had to start a reinsurance company out of Bermuda. So that's what Newport Re was. We started, a reinsurance company to transact our business. Um, and, we off the gate launched two fairly successful um, private hedge funds in PIMCO doing insurance-linked securities. Ran that for about 4 years plus. We also were the specialist desk within PIMCO for all the other PIMCO funds that were interested in ILS, insurance-linked securities or catastrophe bonds. So we would basically underwrite those transactions or securities on behalf of the broader PIMCO complex. Um,
that's
so
amazing.
yeah, it was a fascinating experience, steep learning curve again. But yeah, uh, very smart, surrounded by very smart people. You learn, in every conversation. It's really, something, that I have fond memories of.
So let's transition to Kingsridge. Um, um, you right now you're looking at insurance linked securities. I'm assuming it's still based on catastrophe and weather risk. Am I correct?
That's right. That's right.
So for someone who's completely new to this, right? Doesn't really know anything, other than basics, climate change, you know, maybe catastrophic risk and weather risk are becoming much more important, right?
Yeah.
In the viewpoint of a large majority of people. And now everything you do has to be involved with being able to assess that weather risk,
Yeah.
assess the catastrophic risk. So it sounds, Stevie, I'm assuming you still have the 2 week forward view, 2 weeks to the next couple months or however long it may
Yeah.
be. Um, um, Tell me, what is it you do? Like how does someone do what you do? Because everything else is derived from that fountainhead. Is
Yeah.
there is
Yeah.
there is there AI, or are there software programs that look? What does this look like?
Yeah. So, it's a very, I would say, niche domain, right? It
Mm,
requires, practitioners who are steeped in this domain, right? It's a combination of the scientific understanding of catastrophe risk, right? You need to
mm,
have a good command on that, because that's the underlying risk that you're assuming, and also the insurance reinsurance industry, right? Because your key counterparties tend to be the insurance reinsurance industry players and how that market works.
mm,
So when it comes to catastrophe risk, there's obviously, we talked about hurricane risk, but there are other kinds of catastrophes also. There's hailstorms and wildfires. There's flood risk. There's typhoons in Japan. You name it. There's a whole host of meteorological catastrophes, and then there are geophysical, earthquakes. We just had, one in Venezuela a couple of days back. So there's, risk of various kinds that insurance companies assume on their balance sheet because of that's the business they are in, right? So if you're providing insurance to homeowners in Florida, you're assuming the hurricane risk from homeowners in Florida into your balance sheet. Now, the insurance companies try to, buy reinsurance a lot of times to pass on some of that risk over to the reinsurers. But they also retain a certain amount of risk on their balance sheet. And regulators are very concerned when insurance companies retain more than a certain amount of what's called episodic risk, right? So this is one event can have a big impact on your balance sheet. Regulators do not want that.
On their whole book, basically.
Exactly. Yep. So they monitor it very closely and they mandate to both insurance companies and reinsurance companies that they should keep that within certain bounds.
Just right? Kind of like regulating a bank's liquidity.
Absolutely.
Yeah.
It's regulators. It's also capital markets also do not like volatility. So if you're an investor in a particular company, you don't want to own a volatile stock, right? So these companies then purchase what's called insurance-linked securities, right? Or they issue insurance-linked securities to the market. So one form of insurance-linked security is a catastrophe bond, which packages the hurricane risk or the earthquake risk or the wildfire risk of that company and passes that on to the capital markets in the form of a bond, the catastrophe risk bond. So what's unique about it is it's not a corporate bond issued by those companies, right? We are not taking operational risk of those companies not performing well. All it's transferring is the catastrophe risk.
Got it.
So it's a contingent bond that is triggered by a particular event of a certain magnitude, which might impact their balance sheet to a certain extent, right?
Got it.
So there's various contingencies.
So let me just make sure I got that all. So I'm a company. I want to sell some of my risk, right?
That's
so right. There maybe I'm not doing myself, but I'm getting help from different companies, insurance companies, whatever, to package they create an insurance instrument where now I'm insured against that risk. The insurance companies and the reinsurance companies, they don't want to hold due to certain regulatory boundaries or even their own internal risk frameworks, right? They don't want to hold too much of certain types of risk, so they want to offload that risk themselves. And so then comes other parties that will then will package different ILS instruments, right? And into an overall bond that people in the market will want to buy. Now, I'm assuming people who have experts in weather and catastrophic risk and knows how who has a lot of experience structuring the underlying insurance policies can find different arbitrage opportunities that may be available due to analysis of a differing analysis of the weather or catastrophic risk, or in just basically how those insurance policies have been structured. Am I right? Am I understanding the flow there?
I think you got it almost there, right? So yes, people who understand that space can. I would characterize it as people who understand the space can construct more higher quality portfolios, right? They can steer the portfolio to a, let's call it, value, for risk angle. It's not really arbitrage game because it's not a ultra liquid market where you can arbitrage this risk. At the end of the day, this is a bond. It's not an equity transaction.
Understood.
Right. but there is value in creating a high quality portfolio, right? That avoids the worst possible bonds, right, in the universe, and that creates the kinds of returns that investors seek with the lowest possible risk
Yep.
that is possible.
You're clipping
right?
coupons
Yeah,
to getting an income that
yeah,
you have to make a decision. Is this income enough? And is my risk diversified enough across
yeah,
the underlying instruments that I'm holding, that such that the coupon is enough for that risk, right? And in order
absolutely.
to evaluate that, you have to be pretty damn good at at climate,
Yeah,
weather, and
yeah,
catastrophic risk, right?
exactly,
Yep.
exactly.
And
It's
so,
the name of the
what is
game.
it? What are the typical holding like? So it's kind of a buy and hold. People, not you specifically, but in general, people are taking like a buy and hold type of strategy since there's not an extremely liquid market.
Um, I would say the catastrophe bond market is it's basically 144A securities, right? So these are bonds that are issued to qualified institutional buyers. Um, there is a certain amount of trading that happens, right? So we do trade in and out, often. However, um, the private ILS, the private insurance linked securities market, is not liquid. It has typically the funds in the private ILS market, they have a 1 year lockup.
Mm,
And, they allow those, whatever they buy to expire during that 1 year period. In the catastrophe bond market, the liquidity allows us to offer the ETFs that we have offered, right? So we
got it.
have two ETFs. We allow daily liquidity on those
Hmm.
ETFs. In fact, you can trade intraday because it's an ETF. So the
Interesting.
catastrophe bond market has the ability, um, and we manage our portfolio so that we can respond to creates and redeems as they happen.
Well, thanks for reminding about the ETF. So this you can talk about we can talk about products more openly rather than just the generality behind it. So you have how many ETFs do you have?
We have two ETFs. We launched one in the US in April 2025. Coincidentally, the day of the Liberation Day, where the tariffs were issued on April 2025.
Yeah, that's funny.
Uh, and the interesting thing is the correlation thesis that we were talking about. Um, you know, it is, it was proven right at the launch because, in April, our ETF was one of the few funds that didn't get impacted by that.
No,
Um,
fantastic.
but that was launched in April of last year. And then early this year, in January, we launched a set of ETFs in Europe.
Hmm.
So in London, Frankfurt, and Milan exchanges. So the UCITS ETF, which is a similar concept and product
Hmm.
as the US ETF, but caters to a European audience.
That makes sense. So we're obviously in the middle of some extreme changes in the world, right? AI, chief among them. Um, I imagine there's a lot of technology behind what you do, a lot of analytics behind what you do. You probably have to have access to an amazing data. You probably have, I would probably call it a raging river of data compared to a lot of other potential strategies, right? How do you
Yeah.
manage that? How do you manage all that? And how is AI changing? I would say how climatologists, weather experts are underwriting risk, and then how is it changing how you underwrite risk, maybe differently or
Yeah.
expanding upon that for the asset and investment use case.
Yeah, look, I think you hit it right on the head. We do find ourselves in a data-heavy environment, right? So when you're talking about, natural disasters, there's hundreds of years of historical record
Hmm.
um, and global footprint, right? We're talking about disasters everywhere in the world that we have to monitor and assess and model. And the kinds of models that we use to assess, these disasters tend to be fairly sophisticated scenario models. We build stochastic scenarios with tens of thousands of potential outcomes. And these are like geographic in footprint. Think of a hurricane that might be going past Miami, possibly hitting New York, and everything in between, right? The models we use are called catastrophe risk models. There are some established vendors who built them over the past 30 years. So we definitely use them as our benchmark models. These, they spit out gigabytes of data, right? And our task as underwriters, portfolio managers, is to condense that into actionable metrics that tell us, hey, this bond is priced well or not. This is a bond that we should stay away from, things like that. A lot of these models, they are built with a certain amount of AI knowledge in them. Like traditionally, before AI became the thing, right? It used to be called machine learning.
Yep.
And machine learning has been around for decades. And a lot of these climate, weather models and stochastic models have used machine learning in their process. Having said that, I think the recent development in generative AI is very compelling. It is opening up possibilities to make more sophisticated models. One of the challenges, for instance, in climate and weather phenomenon is they tend to be at a very large scale, right? So you're talking about signals that are, let's say, for the entire Midwest or for the Northeast. Because these are global models, they have resolutions of 100 kilometers or higher. That's the only way those can be run. AI models are allowing that resolution to be kind of finer grained, right? So that AI, putting an AI layer onto that allows you to make it more granular, down to a kilometer resolution, which is compelling for certain use cases because now you can actually resolve, more realistic features. So that's a new development. And then in real time response, right? That's an important component of what we do, right? When a hurricane is approaching us, a few days out, we can see the forecast, right? And there are certain actions we can take as portfolio managers to respond to that. If we think that, we need to hedge our portfolio or we need to buy a protection or we need to sell something. And so that's for us as portfolio managers. Risk owners, so these are business entities or individuals whose risk is constituted in the portfolio. They can also take mitigation action should they get high quality forecasts. And that ultimately impacts the outcome for the catastrophe bond holders. So we are seeing some pretty impressive developments in the last year or so in that space. You might be aware of Google DeepMind, which is Google's Gen AI frontier. They have been doing a lot of work in weather forecasting and in particular hurricane forecasting. So last year their hurricane forecast model was actually the most accurate in the world compared to the National Hurricane Center or the European Center for Weather Forecasting. They put out their forecast and within that was the first year they made it public and it turned out to be the most accurate. So that was impressive. It improved the lead time of those forecasts. So the time the number of days ahead you can know where the hurricane will actually make landfall. That has a big impact. So we are looking forward to what's coming on the horizon. That was last year, and as we know in the world of AI, last year was long time ago.
Yeah, yeah,
Things are
yeah.
things are moving much faster at a much
Yeah.
faster pace. So there's a lot happening, and we are excited. We want to take advantage of what's available. We do, you know, think about AI as a very, in a very pragmatic way. We think there are analytics potential that we want to fully maximize. There are workflow efficiencies that we want to maximize.
Hmm.
But at the same time, we do not want to use AI for investment decision making. That's not.
That's not.
We don't think it's there, and there's nuances,
Mhm.
um, and fiduciary responsibilities that we have that we cannot just leave it to AI. So we
So,
use it where it's compelling,
and,
and then we
and
kind of
yeah, and then don't use it for the stuff that's not. So it's
yeah
something that hit me is you're talking about a lot about the AI improvements for detecting catastrophic or predicting catastrophic
yeah
risk, or weather risk. But I imagine that there's another side of what you're doing is okay, if there's going to be a hurricane in this region, well, what bonds do we hold? Which
yeah
what insurance policies are the components of the bonds we hold, and are what companies are affected by this specific event, right? I'll just take a multinational conglomerate ABC,
hmm,
right? How do you know? Maybe a multi-conglomerate ABC has a insurance policy against hurricanes, let's say. In the
yeah.
policy, does it list the locations that they're insuring? So like do you have that data available so you can like cross-reference, uh-oh, I'm predicting a hurricane here. What
Yeah.
assets do I own are affected by that?
So, with some different levels of granularity with different bonds, right?
Okay.
So, if I was an insurance company, yes, I would have all that data at my fingertips because, that's how they would
They
assume
underwrite
the
it.
risk of that
Hmm.
ABC company, right? Um, when those insurance companies issue bonds, they are not doing it at an individual underlying company level. They are doing it at the whole portfolio level. So they might aggregate that information to some extent, and they will
Hmm.
tell us, hey, this is our exposure in all the counties, in different counties at the county level. So we'll have that information aggregated to a county level or
And
town level.
approximate value amount,
Exactly.
right?
Yeah.
Got it.
Yeah.
Got it. Okay. So that data's there for you. Sorry, just
Yeah.
my mind's turning about
Yeah.
what data would I want if I was in your position? I'm
Yeah.
sure there's a
Yeah.
million things I'm missing, but those seem to be the two categories: the risk of an event of weather or catastrophic effects versus what are the assets exposed, right?
Absolutely.
Yeah, yeah. So
Absolutely.
you got to somehow triangulate those together. And I imagine you probably are very much got algorithms and programs in place to quickly, when a weather event's coming, to quickly
Yeah.
go, all right, this is what's exposed. These are the instruments where that exposure is.
Yeah.
And then from there, you probably have a decisioning workflow that you have to go through.
Exactly. When there's a major event brewing, that's
Hmm.
we kind of put all hands on deck. We, call what we have constituted as a major event task force. So it's almost like a war room situation.
Yep,
And,
understood.
we are trying to respond, we are trying to see how that impacts our portfolios, impacts valuations, all of that stuff. Yeah.
So, um, it's obvious that you have experience that probably is among the elite of the elite in what you do with your background. So beyond just your experience and all the battles you've been through over, what would you want to leave with viewers of the podcast with to go what should they know about Kingridge and your edge in beyond experience in choose buying and selling these ILS securities and wrapping them up in an ETF instruments that they can buy or invest in.
I would say, it's a combination of the experience that you just mentioned, Having been through multiple firms where, we've had leadership roles, having been through multiple catastrophes, right? So when I started off my career, I was mentioning 2004 and 2005, very active hurricane years. You get a good sense of what works, what doesn't work. And you also you observe what's happening in the market, who made the right choices, who made the wrong choices. This industry is all about institutional memory, right? It's about really knowing, can you survive the next catastrophe, right? Can you thrive during that? Because that's what separates that's what separates the boys from the men, so to say, right?
Yeah, makes sense.
I think at the end of the day, our goal is, we want to innovate in how we design our products. We want to innovate in our process, in our workflow efficiencies. But at the end of the day, we are in an industry that has got a long history, and that history is something that we regard very highly. So we take that seriously. We are very conservative in how we manage our portfolios, and we take our fiduciary responsibility very seriously.
Understood. So let's talk about your clientele. These are ETFs. They're liquid ETFs. Who are your typical buyers? Are these individuals? Are these RIAs? Are these institutions that invest in your ETFs?
It's a mix. I would say, of course, it's open and available to retail investors. And so anybody can go and purchase it on their brokerage account. But the biggest traction we are receiving is from institutions and RIAs, right? Because they are managing assets on behalf of their clients. Institutions who would like to have daily liquidity, daily pricing on their assets. This is the avenue that they choose, right? Because this gives them that flexibility. So we've found interest from a whole host of institutional managers as well as RIAs.
Got it. And they're looking for essentially an uncorrelated, steady kind of the turtle beats the hare return stream.
Yeah, I would say, every institutional investor or RIA is trying to construct a diversified portfolio for their client, right? And they would have equities, they would have fixed income, some alternatives. We kind of sit in the fixed income / alternatives bucket, right?
But uncorrelated, which makes you attractive.
What we offer in that bucket is it's uncorrelated to, it's more truly uncorrelated to equities than fixed income, because we've seen cases in recent past where fixed income in theory is uncorrelated, but when there is a crisis, it's not uncorrelated.
They move the same way more often than you would like.
Exactly. So we are truly uncorrelated in the tail as well. And then while being uncorrelated, we are also able to offer higher yield compared to comparable fixed income, right?
Nice.
So it's a win-win on both fronts.
Got it. And then how would someone find your ETFs? Are there tickers, or do you want to give your website to the viewers here?
Absolutely. So our US ETF ticker is ILS. It's short for
insurance-linked securities. Yeah.
And the European ETF, which is a UCITS ETF, is CATB. So CATB, as in cat bond. They are available on your, whatever trading brokerage account you work on. You can see them. We do have websites for each of them. Our Kingridge Capital website is kingridgecapital.com. You can go there and you can find links to both of those ETFs. And we have a whole host of educational material on our website. we have FAQs, we have white papers. So, you know, we totally understand that investors need, they have a lot of questions, so they can dig into it and they can reach out to any one of us if they want to have a further conversation.
Well, this was a fascinating conversation. I always love when it's not just another long short or what have you. And and there's I think it should be very clear. There's a lot of great long short managers that do very, very different things. But this one is very different on the surface. You don't have to dig
Ab-
too deeply on this one.
Absolutely.
And it's kudos to you on your great background, the wars you've been through per se, to learn this what probably is a very difficult strategy to probably master, and an area of expertise to master. And I wish you all the best of luck, and I would love to have you return another episode in the future.
Absolutely, Ben. It was a pleasure.
Thank you so much, everybody. This is Ben Webster from the Scaling Alpha podcast signing off, and we'll hope to see you for the next episode. Thank you.